Welcome back to Market on Close. We've had a slew of economic data this morning, and we've got a big number tomorrow. So far, today's has led to lower yields, but let's talk about what's on the way. Scott Bowers with us. Once more, the CEO of Prosper Trading Academy. Scott, we had a mixed bag today, right? We had jobless claims that were real good. Productivity and costs were solid across the board. Then manufacturing came in, and things looked a little bit soft. Did this inform bond activity today?
Yeah, probably. Everyone's looking ahead to tomorrow, but I will tell you, when you put all of those numbers in the macro piece of the puzzle instead of individually, what it shows to me is there has been some continued softness. Not a ton, but we've seen some continued softness. Let's look what the wage number is tomorrow. That to me is really the big one, Oliver. And if that wage number is still on, the light side, what I think is going to happen, and I was talking to Ben about this morning, what I think is going to happen is you're going to get the December rate hike, but you may start seeing the Fed ease up a little bit on their rhetoric because, quite frankly, over the last 4, 6, maybe even 8 weeks, the numbers have not been as hot as they had been in previous, 4 to 6 months.
Well, hold on, Scott. I know what you're saying, okay? But I'll play a little devil's advocate here, all right? We haven't been beating at a big rate. If you look at I just go to the Citi Economic Surprise, we've flatlined, but we flatlined at 0, which basically means we're not really surprising to the upside. We're just kind of hitting where we're expected to. So is your point then, Scott, that we have to have something really strong to basically get the market to go, okay, now I see where Powell's coming from? Because if we do miss that wages, I could see how that pressure is going to build and build and build.
Yes, I actually think that for the Fed to either increase their hawkish stance or for the rest of the economy or the people to understand what the Fed is doing, we've got to see a huge, massive outlier number on the upside. Now, that being said, that does not mean any way, shape, or form, in my opinion, that the Fed is acquiescing to the White House, that they may pull back their reins because there's pressure from the White House to not raise rates. No chance. In my book, they're completely separate. The Fed is not doing that. But to me, the numbers are not as strong as they were prior, earlier in the year.
Yeah, no, I think it's fair, Scott. When we especially look at the manufacturing numbers this morning that we saw that slowed a little bit. The wages side of it, we did see earlier in the week that our employment cost index was a little bit warmer than expected. Do you read into that? Do you brace for something strong tomorrow because of that, or are they two separate things?
I think they're two separate things. Especially over the last 2 months or so, there's been such a magnifying glass on every single economic report. The big ones, the small ones, the ones in the middle, such a magnifying glass. And again, you got to take a step back, look at a more macro picture. But tomorrow is one of the big ones. I think it stands alone. I don't think the number we saw earlier this week is going to have much to do with that. And, perhaps it's going to come in right in line. And then it just puts the question mark back out there again. Again, my point being, if it comes in soft, I think that really starts to lead the Fed, and we're going to hear a little bit next week even, maybe to ease up on their rhetoric a bit.
Yeah. Scott, we look at the bond market as a result of this last point. So I want to think about what Treasuries, how Treasuries will respond to this. At this point, for me, it's tough to figure out basically because throughout the worst part of this sell-off in equities, there's never really been a convincing buy into 10 years. You know what I mean? You know where I'm going with that. Yes, we're lower off that high, but barely, right? We're at 314. High is just 100 basis points away, basically.
You just hit the nail on the head when you say, you don't really know what to make of it. And I think the overall market feels the same way. And that's why we're just kind of treading right now. Once we've kind of just kind of flatlined in this 314, 313 area right now. I don't know what that next catalyst is going to be to make, rates go higher or lower. And I think that is really the prevailing kind of sentiment out there is we just don't know, right? We had that rise up from 290 or 3% so quickly to 320-ish that it really caught people off guard. It caught the market by surprise. Now people, the reins are coming in a little bit, and I don't know. I haven't spoken to anyone that yet has told me what is going to be the next catalyst for the move one way or the other. Yeah. And I certainly don't know.
Yeah, no, I think it's fair. Does this, at this point, Scott, last thing here, second to last, the second last thing, I guess, which is bonds the conviction, if as we think about what happens there. Stocks, though, we've had the selling. All right, we're close. We had a nice day today, yesterday, and the day before, so we're off the lows. But if that inflation number for wages does come with a strong read-through, is this stocks negative?
Yeah, it probably is in the short run. I think because that is the market psychology, and that's how people are trained to react to a number like that. Now, do we have to still look at the macro picture? We do. We have to look at earnings. We have to look at what is projected here. But I do think if we see a real hot number, I think we're down. We're going to be down, fairly decently. I'm not saying 2-3% or anything tomorrow, but I think that this, temporary market rally is going to come to a screeching halt.
Yeah. All right, Scott, great stuff. We will look forward to following up on it. I know we will, Mr. Bauer. It's always a pleasure.